Ladies and gentlemen, welcome back to the channel. We have some big events coming next week, and the Fed is likely going to, well, rug pull the markets. Now, rug pulling the markets is really based around expectations. I'm going to go over the expectations the markets have currently for Fed policy and implied Fed policy throughout 2024, meaning how many rate cuts are the markets currently pricing in. And the problem really lies in there's no chance of a rate hike. And I think with recent inflation trends, the Fed has to put the optionality back on the table that they will raise rates again if they need to. If in fact the neutral rate is higher than what they previously thought. And I will go over my expectations for what the Fed is actually going to say, do, and how the markets are likely to react to it. Hit the like button and subscribe to the channel if this is your first time here. Consider sticking around a while, and let's get started. First thing I actually want to start with is the markets are starting to kind of sell off a little bit here. The NASDAQ broke down, and the NASDAQ has been in a very bullish trend, but any which way you want to form this low-end support line, you've broken down. On Friday, you broke down. Okay? Doesn't matter which way or what points you want to connect here, any of them support a breakdown of the NASDAQ. Now that's significant because that sets you up for more downside. See, momentum is a beautiful thing. Momentum works great to the upside, and the markets have seen a lot of upside momentum recently. When momentum breaks down to the downside, it can be very strong as well. Now, let me give you a question first just to really get this video going. Why has the markets rallied so aggressively? Why? Well, we started 2024 expecting 7 rate cuts. 7 rate cuts in 2024. That's obviously not what we're currently pricing in. What we're pricing in as of right now, we'll count them together. On the December 18th Fed meeting, so the last Fed meeting of 2024, the markets are pricing in 1, 2, 3 rate cuts by then to have a Fed funds rate between 4.5 and 4.75%. So you've went from pricing in 7 rate cuts down to pricing in 3 rate cuts, yet the markets have continued with this upside momentum. It was never about 7 rate cuts, 6, 5, 4, 3, 2, or 1 rate cuts. It's not even about that. The reason why the markets have been rallying is because the markets are determined, dead set. The next move from the Fed is a cut. Well, I think the Fed has to put that back on the table that we may get another rate hike. Now, based on the data that we've gotten so far in 2024, I don't think the Fed's base case is going to be for raising rates again, clearly, but they're definitely going to put it on the table that they may need to raise rates again. And that undermines the exact reason why stocks have been going higher. Now, I don't necessarily think you get some kind of huge sell-off if the Fed comes out and they say, yep, we're still not thinking about raising rates, or that we will have to raise rates again, and maybe the dot plot falls to 2 rate cuts. Well, this was the last dot plot we had, pricing in a Fed funds rate by the end of 2024 at 4.6%. This was even as inflation was falling like a rock in the second half of 2023. This summary of economic projections came out December 13th. Well, yeah, not so much now. Now, in 2024, every single CPI, PPI, and PCE report that we have gotten has come in hotter than expected. Every single one of them. So, the Fed here was pricing in 2 to 3 rate cuts in 2024. Odds are that's going to fall back to about 1 rate cut. Now, it depends. This is based on an aggregate of each and every single Fed official's expectations. And it just basically gives you an average of their expectations. So on average, I think you're going to price in maybe 1 rate cut in 2024. That would be anything between 5.1 to 5.25% for the projected Fed funds rate by the end of the year. So that's kind of what I'm expecting there. But I do think the Fed is going to make it clear. If inflation continues to come in hot in 2024, the Fed will raise rates again, that they will not hesitate to raise rates again if they need to. That's very different than what the Fed has said recently. The Fed has basically jacked up everyone's expectations that no matter what happens, This is the logic. No matter what happens with inflation, the next move from the Fed is a cut. And I think the Fed really needs to reverse that. Let me just show you how kind of crazy this is. Based on today, there's a 1.2% chance that we get 0 rate cuts in 2024. A 1.2% chance. So basically, nobody is expecting no rate cuts in 2024. What do you think the odds are of a hike from here? 0. Probably negative. Okay? Nobody is expecting the Fed will actually have to raise rates again. So if the Fed puts that optionality out there, that's equivalent to a rug pull. Nobody's expecting that. That would be like if you were expecting the Fed to pause, like we are in March. We're not expecting the Fed coming this Wednesday to raise rates or to lower rates. But it would be like if the Fed came out and cut rates in March. That would be a rug pull, and the markets would freak out because really nobody's expecting that. Only 2% of investors are expecting that. Or if the Fed came out and raised rates in March, which again, I don't think is going to happen, that would be a rug pull as well. But the Fed putting the optionality back on the table to potentially raise rates again, that would also be the equivalent of a rug pull. So that's my expectation. The Fed is going to, on their dot plot, price in about 1 rate cut. That's it. And the Fed, in the press conference, Jerome Powell is going to make it very clear that recent inflation trends have been worrisome, and if they need to raise rates again, they will. That's where you get the larger downside because, again, there's a 0% chance the Fed raises rates in 2024, and that would defy the exact reason why the markets have been going higher. And I think that's where you have a big problem on your hands. Now, coming on Monday, I want to mention this. You will also have the NVIDIA GTC conference. Now, NVIDIA, ever since last earnings, I think people have been buying the rumor of this conference. It wouldn't surprise me if you get a sell the news event coming on Monday and on Tuesday. And that could also shift, momentum away from momentum stocks like AI stocks, semiconductors right now, and maybe cause a further broadening out of our markets. We've seen that on Friday. The Russell outperformed. The Russell was green. The NASDAQ was down about 1%. And you can even see NVIDIA kind of rallied in the beginning of the trading day, traded sideways, traded downwards, rallied a little bit towards the end of the day, and then just sold off, towards the end of the day and actually closed red. This looks like a, sell the rumor kind of precursor move to me, and that could be a problem for the broader indexes. And again, the NASDAQ has already broke down, already looking quite bearish now. And I think you could inevitably fall back to about your 50-day moving average even before Wednesday of this upcoming week. So before we even hear from Powell, you're probably going to fall to that 50-day moving average, again, based on that NVIDIA sell the news event and the jitters that people are going to have before the Fed. Now, Goldman Sachs came out on Thursday, and Goldman Sachs says their volatility model sees an average of 21.5 on the VIX in April compared to the current level of 15. So Goldman Sachs is coming out and telling clients that the VIX is likely to spike pretty big. Now, the last time the VIX was over 20 was during the October-November correction that we had in 2023. The VIX briefly hit a high of about 23, but was sitting right at about 22 to 21 for this period of time. Based on just that math alone, that would suggest maybe 5 to 10% downside in the NASDAQ just to get back to over 20 on the VIX. Now, Goldman Sachs says, we believe, number one, the VIX at a historically low level. Number two, the SPX close to all-time highs. The S&P, that's SPX. Number three, high demand for upside asymmetry. Number four, our model estimated upside to VIX. And five, upcoming macro/micro catalysts offer a compelling case for investors to own VIX calls. Over the past 30 plus years, VIX has averaged 19 in April, and we see upside risk to the current low VIX levels given current macro environment and upcoming macro/micro catalysts. S&P 500 index skew is close to multi-year lows, indicating the upside asymmetry is crowded, and we believe VIX calls would be an attractive hedge in case of a pullback in equities. They are suggesting their clients to buy $16 VIX calls expiring in April. Very short term, very bearish call. That's, to get a spike in the VIX that aggressive, you would need to see quite the downside. Now, the VIX, for anyone that does not know, measures the calls and the puts on the S&P. So when the VIX spikes, when the VIX goes higher, that means there's more puts being bought on the S&P than calls. When the VIX goes lower or stays low, that means there's more calls being bought on the S&P than puts. So, Goldman Sachs is suggesting that we could go through quite a pullback here. Now, in other worrying news we had last week, McDonald's CFO Ian Borden warned about a decline in traffic in 2024. He says, quote, some of those customers are just choosing to eat at home more often, he said at a conference on Wednesday. As a result, the fast food industry looks primed for a price war to draw consumers back through their doors. If McDonald's is talking about a price war, the consumer is likely not doing great. Okay, so maybe there's a chance that we stick with 2 to 3 rate cuts in 2024 based on that logic. Now, the other thing I want to point out is what a lot of guys on Wall Street have also been pointing out. July is the last Fed meeting that you likely will get a rate cut. So if we don't get a cut in March, if we don't get a cut in May, the first cut could be in June. That's when the markets are pricing in the first cut. 55.2% chance of a cut, 41.2% chance of a pause. If we don't get a cut in June, we don't get a cut in July, we're not going to get a cut likely at all this year. If we do, it's going to be the day after the election on November 7th. Why is that? Well, it's very political. The Fed has been attacked by really both sides of the political party because some people in Congress, the Senate, the House, believe the Fed should not be an independent body, that they are very politically motivated. For whatever reason or another, maybe that's true, maybe that's false, doesn't matter. The Fed wants to make it clear they're not politically motivated, so they're not going to be aggressively cutting rates before the election unless something were to dramatically break in the markets. So you can expect maybe more cuts after the November election, maybe into December. But if you don't get a rate cut by July, the Fed's probably not cutting rates in September just because of how political that would look. Look like they were kind of trying to help one side or the other. And that's also problematic for our markets because if inflation continues to spike for another month or two, next thing you know, it's going to be July and we're not going to be getting a rate cut at all. So I think for these reasons, you're likely to get rug pulled next week by the Fed. And that's a problem when the NASDAQ and the S&P are trading at these rich prices. Now, next week, you also have some earnings. Tuesday pre-market, you have XPeng, and that's really the only notable name for Monday and Tuesday. Wednesday, you get started with Micron. Micron, if they have bad earnings, that could just beat down the AI trade even more, considering if we do get a sell the news event with NVIDIA's GTC conference, the hype is off the charts. I will be surprised if NVIDIA stock does rally following that event. You will also get Chewy earnings, KB Home, Five Below, and Guess that will report. Thursday pre-market, Intuitive Machines, and Darden Restaurants. General Mills also Wednesday pre-market. General Mills, that's one you want to watch for inflation, especially in food. If they have anything inflationary to say, that could be important. Darden Restaurants, they own Olive Garden, some other smaller chains. So definitely want to see what they say about the consumer. Now, Thursday and after hours, you will get Nike, Lululemon, FedEx, and some other names. These three are really consumer-centric names as well. Nike, Lulu, and FedEx, if they have bad earnings, that's going to give you a pretty bad sign for the consumer ahead. Now, also something notable to point out is last week we had like $4 trillion of derivatives expire. These are options. These are futures, right? It was a triple witching last week. And you've been so bullish in the markets as of the last couple of months. A lot of that positioning was likely in calls and upside positions in futures and in options. We'll see with the breakdown in the NASDAQ on Friday, the triple Qs, if some of that money, potentially trillions of dollars of that money, goes into hedging out portfolios. That would make some sense on a risk to reward basis, considering what we're talking about here in this video. And that could lead to more downside, more momentum to the downside. Momentum has been great to the upside, but is it gonna be, big to the downside as well? I think that's a question that we don't know, that will really come down to the Fed. Now, also something to consider is TLT has been responding to the bad data, responding to the bad news that we have gotten in 2024, but the markets have not. So to start 2024, TLT was at about $99. Today it's at $92. That's because we continue to see bad inflation data coming out and, stronger than expected economic data to some degree, and the bond market is reacting. This suggests stocks should be lower than where they are. That means 10-year treasury yields have been actually rising in 2024, and that's true. 10-year treasury yields to start 2024 were down here at about 3.86%. Today, they're 4.3%. So you've seen like 50 basis points, equivalent to like 2 rate cuts or rate hikes in 2024. Now, that's a problem, and markets have not reacted to that. You also have this. The Goldman Sachs Global Financial Conditions Index is at some of the loosest positions or loosest stances you have been at in the economy since a long time now, since like 2014. So despite the Fed's actions, money's easy out there. Policy is light, apparently. It's where you're not too restrictive. And this is something that the Fed might look at and say, well, are we at neutral? Do we need to raise rates again to ensure inflation does fall to that 2% target? Probably. 3-month annualized PCE is back to like 6.9%. So if this trend continues for the next couple of months, you're going to be looking at some rough year-over-year comparisons. Give it like 6 months. And yeah, that's a big problem. Let me know what you think about this information down below in the comment section. My actual opinion for the S&P and the NASDAQ is you are going into a correction. You will likely see 10%. Whether you get 10% downside from the peak of this NASDAQ rally, that would put you back to about 404 on the NASDAQ. If you get 10% lower from here, depending on where you want to calculate this, you will get down to roughly about 490 on the NASDAQ. That would be I believe your prior all-time high, or pretty close to that. That would be your high in July of 2023. You likely get back to that. Yeah, that wouldn't surprise me. At the bare minimum, you're getting down to about 400 on the NASDAQ. That would be my personal opinion. That would be a drop of about $34 or so from here. And, I mean, you've rallied from about 340 on the NASDAQ for the October-November low to where we are now. So would that be too crazy? Probably not, but I don't think it's expected by a lot of people that we're going to get a Fed rug pull next week, and I'm here to tell you that Fed rug pull is more likely than not. Hit the like button, subscribe to the channel, let me know what you think about this information down below in the comment section. You guys have a fantastic rest of your day, and I will see you in the next one.